Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Thursday, December 17th, 2020. And here are our top stories. We'll take a look back at the markets and the economy in 2020, and then we'll look ahead to what we can expect in 2021. Joining me now to discuss this and more is Dr. David Kelly. He's Chief Global Strategist for JP Morgan Asset Management. Dr. Kelly, thanks so much for joining us on the program this morning.
Glad to be here.
So David, we're coming down the home stretch. We're coming to the end of the year, and 2020 has been an extraordinary year like no other. But I wanted to spend this first segment getting your thoughts as let's look back at kind of what we went through, not just the COVID pandemic, but the impact economically and financially to Americans.
Yes, as you say, it's been an extraordinary year, a very difficult year. I think the worst of it is what it's done to all of our lives. But a close second is what it's done to the economy. We saw a massive recession emerge in the first and second quarters of this year, really the biggest that we've seen since World War II. But then a very swift recovery, or partial recovery from that, as the manufacturing sector reopened and other parts of the economy reopened. But the rest of the economy still is in trouble. I mean, there's still huge swaths of the economy that can't operate in a pandemic. And there are millions of Americans, I estimate about 10 million Americans, who don't have a job right now, who did have one back in February. And that's a lot of hardship. There's a lot of hardship behind those numbers. And unfortunately, that continues until the pandemic is fixed. So that's going on. But then when you look at financial markets really tend to be forward-looking, and a lot of companies have actually weathered this quite well. Particularly big tech companies have done very well in terms of earnings, revenues, and so forth. So when you look at financial markets, they've actually ridden this out very well. So it's really been a terrible year for society around the world, a very bad year for global economies, but actually not that bad a year for financial markets.
And David, you mentioned kind of let's just take America as an example, the trials and tribulations. You mentioned there are 10 million Americans who may not have a job, do not have a job. And there was this passage during the year of stimulus. We had the CARES Act, which essentially established some infrastructure to support people. Any sense, and we're recording this on a Tuesday morning, and so there are obviously a few more days to go in the week, but any sense for if we could get stimulus? I know that there are a lot of people calling for it, and I think it would probably help out a lot of people as well.
Well, I think we will get some further relief. I prefer calling it support than stimulus, because I think it's really important to understand what we need here. I remember a few weeks ago, President-elect Biden hurt his foot, and they put him in a boot, and I suppose that's pretty awkward walking around in a boot, but he was injured and he needed the support. If instead his doctors had told him, well, just run it off and drink more caffeine and a few steroids, you'll be fine, that would be malpractice. Because the truth is, he wasn't tired in need of stimulus, he was injured in need of support. And that's really what this economy is. We can't get the economy back to normal until we handle the pandemic. And so whatever the government passes, and I think the government will pass something, but whatever it passes really needs to be to try to support people through a pandemic environment, not make the pandemic worse, help people through this difficult winter until these vaccines can have their effect. So we do need support, and hopefully we will get support in the next few days, and then hopefully perhaps another dose of it early next year.
Yeah, I think a lot of people have their fingers crossed. And David, you mentioned technology doing extremely well, but there are other segments of the economy, just because of the shutdown and the nature of how you go about treating this pandemic, keeping people socially distant, et cetera, hotels, restaurants, a lot of local economies negatively impacted. Is there any historical reference to say how long it potentially could take for some of these smaller businesses to either, kind of ramp things back up and to, get back to some level of normalcy?
Well, there's never in modern history been anything quite like this, but I think we do, based on other events and circumstances, have an idea of what's going to happen. And the reality is that the owners of these businesses are in a lot of trouble, because if they have equity in their businesses, and that wealth is getting eroded and wiped out in many cases. but the physical infrastructure is there. The hotels are there, the restaurants are there, the planes are there. So when we come out of the other side, there will be a lot of people flying, there'll be a lot of people eating at restaurants, there'll be a lot of people staying at hotels. The owners may not be the same people as they were before. That is a great personal tragedy for them and their families. But the economy it's kind of like a forest fire. You come back a few years after a forest fire and you see there's a forest again. It's just not the same trees. And I think that probably is what's going to happen here. So from a cold macroeconomic perspective, I think we'll see a full recovery. But I think there's going to be a lot of personal pain beneath the surface because of that.
Yeah, again, that's just to echo your sentiments, incredibly unfortunate. Let's talk about the health sector, for lack of a better term. Obviously, we rely on these frontline workers to support us during COVID, but there have been some great development this year with vaccinations, and we're just at the point where vaccinations have begun in the UK. They're beginning here in the United States of America, and presumably will begin around the world. But Moderna, Pfizer, I mean, we have seen a tremendous call to action by healthcare, and they have risen to the challenges.
Well, yes, I mean, this has been a real moment in time for the biotech industry. I think when Moderna and Pfizer announced vaccines that are 95% effective against a coronavirus, and remember, coronaviruses were, that's why you don't have a cure for the common cold. They're supposed to be particularly difficult and nasty to try and deal with a vaccine. And to have mRNA technology apparently produce a 95% solution is extraordinary. When I look at this, when I look at some other aspects of what's going on, it's almost like when you have an enormous, terrible human crisis, it forces the pace of innovation in certain industries so that when you come out the other side, you realize that you're almost in a different kind of environment. And I think that the biotech industry will never be the same after this. I think that they will thankfully be able to deal with a lot of viral problems far better than they've ever been able to deal with them before. And I think there will also be ancillary benefits for other illnesses such as cancer by using this mRNA technology. So I think that is a great leap forward. We've seen other leap forwards in other industries, but it's been a very, very difficult year for everybody in the industry. But we've also seen, that pressure of doing something about this has really forced the pace of innovation and adoption in the biotech industry. And I think that's going to be a permanent benefit from what we've learned this year.
And, as we're taping this on a Tuesday, we're a couple days away from the FOMC meeting, but I'd be remiss to ask you about, just in general, the attitude and the tone and tenor of the Federal Reserve this year up to this point. We don't yet know how the FOMC meeting is going to go, so we can't comment on that. But when you look back and you look at interest rates and you look at the policy, what are some thoughts that you have?
Well, I think that Jay Powell in particular has done an excellent job. He has been determined. He has been resolute and optimistic, and he's also said, he's also done everything that the Fed needs to do to try and help the economy out. And so we've had low interest rates, we've had all these liquidity facilities, we've had major purchases of government bonds, and all that has helped fiscal stimulus. So I think all that they've done well. I think going forward, the challenge for the Federal Reserve is going to be that it can only fix what it can fix. It can't fix our bad public health practices, the fact that we're just not disciplined enough to keep this virus under check. It can't fix the sort of partisanship in Washington, which prevents both sides coming together to enact reasonable legislation to help the economy. And the problem is that when the Fed overplays its hand, when it tries to just use liquidity, its only tool to fix every problem, that can cause long-term problems of its own. So I think I think the Fed's done a good job, but I think there are problems down the road because of the way the Fed has tried to fix some of the things it can't fix.
Yeah. Well, it's certainly going to be interesting to see how things kind of shape up in 2021. And David, with that in mind, I want to go to a quick commercial break. But when we come back, we're going to talk about 2021 and things that you may want to consider. So stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Hi folks, Joe Namath here, and if you're on Medicare, this is important. You're now entitled to eliminate copays and get dental care, dentures, eyeglasses, prescription coverage, in-home aids, unlimited transportation, and home-delivered meals, all at no additional cost. Plus, your zip code may have coverage with the Give Back benefit that adds money back to your Social Security check every month. Look, with the uncertainty of the virus and vaccines, you need to get everything you're entitled to. Here's the bottom line. Call to get significant benefits at no additional cost and see if your zip code has coverage with the Give Back benefit. Millions of people have trusted the Medicare Coverage Helpline. You can too. Call now. It's free.
Call 1-800-924-3920. That's 1-800-924-3920.
Welcome back. We're talking to Dr. David Kelly of JP Morgan Asset Management. Dr. Kelly, thanks so much for staying with us this morning.
Very glad to be here.
So we're coming up to the end of the year, David, and you know, the end of the year is a great time, and it's kind of my public service announcement here, for people to review their portfolio allocations, whether you have $1 million or you have $100 now or $1,000. Now's the time to take a look at things. So when you look out in 2021, what are you thinking about in terms of portfolio, thinking about parts of the economy, and how people should be thinking about their own investing?
Well, I think the first thing is people need to be a little bit cautious and realistic about what returns will be from here. The economy and markets are very often on different sleep cycles. The economy wakes up, the market goes to sleep. The market wakes up, the economy goes to sleep. 2020 was a year in which we had the ultimate in economic and personal stress, and yet the market seems to have done pretty well through it. That's good. But the downside of that is that if you look at current valuations with price-earnings ratios running at about 22 times forward earnings in the S&P 500, with 10-year Treasury yields below 1%, those are both very expensive by historical standards. And we know that if you get into investments that are expensive, then over the long run you get lower returns. You don't know how you're going to get those lower returns, whether it's going to be bumpy or smooth, but you know you're going to get lower returns. So I think people need to be realistic about that. And then they also need to, I think, look carefully within a portfolio to see, well, what within the portfolio is expensive, what's cheap, where am I overweight unintentionally, and where am I underweight, where I really should be thinking of adding some money.
And David, if I'm managing a pension, say I'm a pension manager for a state or a corporation, or even a large asset pool where I've got some liabilities that I have to pay this year, how should they be thinking about? Obviously, it's going to be determinant based on each individual pool of assets, but in general, themes that you're thinking about, are there, for example, indexing versus active management, using non-traditional asset classes? Are things like that crossing your mind?
Yes, different parts of this. I mean, first of all, many institutional investors are sort of tied down because they have to sort of liability match. They have to have a certain amount of fixed income in a portfolio. Overall, high quality, long duration fixed income is pretty expensive here. And to the extent that I could underweight it, I would. And then you've got to find alternatives. Where else you get income? Well, I think one place you get income is in dividend-paying stocks, value stocks in the United States, emerging market equities, European equities. All of them can pay you over 2% dividend yield, with the possibility of those stock prices going up over time. So I think that's a reasonable substitute. I think also, as you say, non-traditional assets, some alternative assets, things like infrastructure, real estate, transportation. If you can access these assets, which give you a good flow of income, that's another way to add to income here. And then also, I think you just need to look at the overall, sort of your overall flexibility in a portfolio. Can you really manage to sort of balance total return and risk? That's the best way to do it, rather than to try to just generate a certain amount of yield. Because, you know, a lot of asset prices have gone up a lot, and that's great. You've got a lot of money, but for your, you know, you've got money to do what you need to do, but you shouldn't stretch out and try to get as much dividend yield or as much coupon yield as possible. You should be willing to sell some principal to generate that income if the asset itself looks pretty expensive in terms of its asset price.
And on January 20th, we have a new president being sworn in. That means potentially new policies and changes. How do you factor in the geopolitical? Because there's could be a complete sea change in geopolitical policies as well as domestic U.S. policies. How does an investor maybe think about those things or do they even think about those things, David? Or do they just say, hey, longer term, I'm bullish, and these are things that I think over long term are not really going to be material?
Well, I think in terms of the broad, does the market rally, does the market fall? It's very, very hard to time that. I mean, markets very often go up after an election, and for the simple reason that uncertainty's gone down. You kind of know where you are. And that's part of the story. Of course, we have the Georgia Senate elections in January, which will determine control of the Senate. But even if the Democrats win those, it will be very narrow control of the Senate. I don't think you'll see a radical agenda pushed through. If the Republicans retain a majority in the Senate, then the Biden administration will have to compromise with Mitch McConnell and the Republicans to try to get things done. So I think you end up with a more middle of the road set of policies on things like taxation and government spending. I do think you'll see more infrastructure spending, whatever happens. Both sides are in favor of doing more in infrastructure spending. I do think you'll see higher deficits or high deficits under either party because, frankly, there are no fiscal hawks left in Washington. But what I do think is going to be where there is going to be big differences in foreign policy, and particularly trade and tariffs. One of the things about the Trump administration is that Donald Trump was very unpredictable when it comes to tariffs and trade. I mean, particularly in 2018, there were tweets going out, and suddenly the tariffs in China were going up, and then they weren't, and then they were, and all that uncertainty really hurt the global trading system, the global economy. And it also strengthened the US dollar because we're actually less dependent on trade for our GDP than other countries are. I think under the Biden administration, we'll see a much more traditional policy. Yes, it will be aggressive towards China. I don't think that Joe Biden will get rid of the tariffs overnight. I think all this will have to be negotiated. But it will be a long-term strategic planned negotiation. And in that kind of environment, I expect global trade will go up, but I also think the US dollar will go down. And I think there's a lower US dollar will help the profits of US multinational corporations. It will help do something about our big trade deficit, but also it will amplify the return on international investments. I mean, it's one of the simplest relationships in finance is that, if overnight the dollar goes down 10%, then the next morning your international assets are worth 10% more in dollar terms. And so I think you will get a dollar tailwind behind a lot of international assets in 2021.
And David, sustainability, ESG, however you want to term it, social impact investing has been very popular in 2020. Would you expect that to continue? It seems like this is a lot more than a trend. This is reality. You see a lot of assets flowing into these types of funds with caution because we don't yet have benchmarks or the ability to measure. There's a lot around transparency. But would you expect that trend to continue and continue its growth?
Absolutely. I think it is incumbent on asset managers to make sure that they manage sustainable funds in a way that maximizes return for investors too. You don't want to have investors get substantially lower returns just because they care about the planet or care about governance or other issues. Having said that, there is a huge demand for this. And a lot of people, particularly, they reach a certain stage in life, they're retired, They've accumulated a lot of assets. Their goal isn't just money. Their goal is to try to do something for the planet, do something for society in their lives. And if they've accumulated a lot of money, that's a way to express that. So I think there will be a great demand for funds which really do help tackle some of the greatest problems we face around the world in terms of inequality, in terms of the climate, in terms of social justice. And so I think there will be a great demand for ESG products and investment opportunities. So I think that's going to be an increasingly big story in the years ahead.
Last question. I'm sorry to hit you with bombarding you with questions, but we only have a short period of time, and I love having you on. Let's talk about digital currency, because just in this last quarter, we've seen a real run up with Bitcoin and other cryptocurrencies. Do cryptocurrencies gain even more stature? There's any new asset class, you have to get your feet wet, understand it. Does this continue to gain momentum in terms of interest from institutional players as well as individuals?
I think there's blockchain technology will. I think digital currencies will overall. But I am very nervous about individual, particularly private sector, digital currencies, because they don't actually serve as a currency. I mean, Bitcoin is not a store of value. It is not an accepted medium of exchange. And it's not a good unit of account. And the reason is because it goes up and down. I mean, it's a speculative asset. A currency is supposed to be stable. That's kind of the whole point of a currency is I give it to you, you give it to the next person, I know what it's worth, you know what it's worth, they know what it's worth. That's what Bitcoin doesn't do. And I think there is going to be a lot of room for digital currencies which are tied to the US dollar or the euro or even the renminbi. I think that is absolutely a wave of the future, but I would be very, very cautious as an individual investor getting into an asset class which you cannot price. And I always, I sort of joke that Bitcoin looks great. Now, what happens if we issue Mitcoin or Zitcoin or Davidcoin? I mean, I'd love to issue Davidcoin, and you can all invest in that if you like. But there's nothing intrinsically valuable about Bitcoin because it's just ether. And unless there's some flow of services or some true limitation or some anchor in terms of store of value, it won't serve as a currency. It will serve as a speculative device. And as you know, when speculation is rife, all these things go up. But then when you have a big market correction, these things can get hurt and hurt very badly. So I'd be very nervous about any particular digital currency as a store of value.
Well, David, I really appreciate you coming on the program today and throughout the year to advise us and keep us up to date on the latest trends economically and financially. Wishing you and your family a very happy holidays and a happy new year. And we look forward to seeing you back in 2021.
Certainly happy to come back in 2021, and hopefully 2021 is a lot easier for all of us than 2020.
Absolutely. Thanks, David. And that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to, then drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our newsletter, The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.